Okay, so a brand new mortgage product dropped today, allowing homeowners the opportunity to build value in their homes and create a new income stream for themselves. This is the new insured refinance product that was announced by the federal government late last year, I believe in the fall of last year. So the main point of this product is to encourage homeowners to refinance their homes with the sole purpose of adding a dwelling to their existing residence. It has to be your home that you occupy or a home that you own that a close relative occupies, like a child or something like that. So it allows you to refinance your home, but you have to use the funds to build like a basement suite, a suite above the garage, or a carriage home or something like that. You can actually build up to 3 additional dwellings on your property, but you got to be zoned for it. You got to get the municipal approvals. You have to get your plans done and everything like that. But it is an opportunity for homeowners to do this. So you might be asking yourself, what's the big deal with this new refinance program available? I can already refinance my home, take out equity, and put in a basement suite right now. That is correct. However, one of the main differences is how much you can borrow relative to the value of your home. With a traditional refinance, you are limited to 80% of your home's current market value as far as how much money you can get out of it. With this new insured refinance program, you can borrow 90% of not just your current value's home. You can borrow 90% of what the value of the home will be worth after the renovation is complete. For example, if you have an $800,000 home with a traditional refinance, you can borrow 80% of that. That's 640 grand. Let's say if you have a $600,000 mortgage, knock that off, leaves you about 40 grand to put in a basement suite. Unfortunately, that's not that much money in today's world in certain markets to get a basement suite done. However, that same house, the exact same house, the same project, if you can go and get an appraisal that says, hey, after I'm done, my house is going to be worth 900 grand because I added a basement suite, you can borrow 90% of that. That equates to $810,000. Knock off your 600 grand mortgage, you could get access to about $210,000 in order to do your renovation. You don't have to use all that money, but you can get enough money to get the renovation done. So another difference that this new refinance program has over a traditional refinance is you have access to insured mortgage rates. This is an insured mortgage program. So traditionally, when you refinance your home, you're paying slightly higher mortgage rates than if you were to purchase a home that's an insured purchase. This could be a difference of 0.5%, 0.75%, kind of depends where the market is, but typically your refinance rates are going to be more expensive than your insured rates. This is an insured program, so you can refinance your home to get the funds to put the basement suite or the carriage home or the suite above the garage in the home, and you have access to the best available rates on the market. So it sounds all gravy, right? It's all good. What could go wrong or what's the downside? Well, this, as I mentioned before, this is an insured mortgage program, meaning that you need to purchase mortgage default insurance in order to participate, in order to push past that 80% loan to value ratio to borrow the funds. And as with any insurance that you got to buy, you got to pay a premium, and it can be pretty hefty depending on how much you borrow. If you go to the full 90%, let's say you borrow $800,000 and that equates to 90% of the finished value of your home, you're going to pay an additional 4.2% of a premium on top of that. That gets put into the mortgage. You pay it over to the life of the mortgage, but it could be a substantial amount of money that you're adding in order to participate in this program. The less the lower you go from that 90% down to 80%, the lower premium you're going to pay. But as with any insurance, there's going to be a premium that you got to pay in order to participate. Where I see an opportunity here is for people who may already be close to that 80% loan to value, and they want to tap into more of their home's equity in order to make an addition to their home to add value and increase cash flow. And it really comes down to what the cost is to participate in this program and go past that 80% mark versus the benefits that you might get from it. And I just want to show you a quick example of how powerful this could possibly be for someone in that situation. So in this example, we have a couple coming up for renewal. A renewal is a great time to refinance because you don't pay a penalty on your mortgage to pay it off. And they want to take out some equity. They want to build a 2-bedroom suite in their house. They have an $800,000 house. They owe about 600 grand, and they found out on a traditional refi they could only get about $640,000. Knock off the 600 grand for a mortgage, only left them $40,000 for the renovation. They decided not to go ahead. They just renewed 600,000 at 4.25% at about payment about 3,200 bucks. And in a year from now, their house is going to go up. They've paid down some of their mortgage, and their remaining equity in their home is about 240 grand. So that's the outcome if they just stick with the status quo. Renew into the $600,000 mortgage. Hopefully, we gain some equity over time. Try and get ahead that way. But what if they did build that two-bedroom suite? What if they took advantage of this new program? Let's take a look at what that could look like. Well, they could use a $900,000 as complete value. That's the value of the home after the renovation is complete. Of that, they can borrow 90%. That's $810,000 available funds. Knock off the $600,000 mortgage, leaves 210 grand available for construction. They don't need all that. They just need 75,000. They do have to pay that insurance premium and gives them a new mortgage of about $692,000. Like a 4.19% interest and insured interest rate gives them a payment over 30-year amortization of $33.69, just over $100 more than what they would have been paying if they just would have renewed into the regular mortgage. But where are they a year from now? And a year from now, their house is now worth $950. It's got that suite in it. Their current balance after paying down for a year is 680 grand, leaves them remaining equity about $270,000. They just increased their net worth by $30,000, but they also have $2,500 more a month added income. Even if you take off that difference in mortgage that they have to pay, that's about $2,368 in net added income. But what if they did this? What if they directed $2,000 of those funds to pay down their mortgage? They say, we're going to add $2,000 to our mortgage payment every single month. Well, by doing that, that turns their 30-year mortgage to a 14-year mortgage. That's a difference of 10 years if they just would have renewed into that $600,000. It's just an example of what you could do with that added income. You can knock off 10 years off your mortgage. What would that mean for you to knock off 10 years from your mortgage by doing something like this? This is what people do. They add value to their homes, they increase their cash flow, and they try and get themselves in a better position financially. It can be very, very powerful stuff.